Hi, I'm Steve Marsten from Southerton's. Thanks for pushing play. Look, this week I want to talk about something which we don't usually get into, that's the political sphere. However, something came to my attention which I think is important that everyone be aware of. In 2008, so I'm just going back in history a little, in 2008 there was a major financial crisis, and during that time, many banks nearly fell over, especially in the US, the big ones, the ones that were deemed too big to fail. And it cost the American public purse billions and billions of dollars. As a matter of fact, they added to their deficit like you've never seen. So it was a massive investment by the government into the banking sector. Now, as a result, the Dodd-Frank Act came into federal law in 2010. That's when the then President Barack Obama signed off on it. The Act was badly needed, and it was the most significant reform of Wall Street since the Depression. Now, the objective of the Act is to limit the exposure of risky financial products and prevent the need for hundreds of billions of dollars in bank and insurance bailouts by the government, which occurred in 2008 and 2009. Now, the Dodd-Frank Act also created a regulatory body called the Consumer Financial Protection Board, and this protects retail customers across the financial sector, smaller banks, payday lenders, credit unions, and mortgage services, and it helps stabilise the financial market. Of course, the big banks at the time, remember, were deemed too big to fail, and as a result of this act, they were subject to more capital requirements. They were subject, and it forced the banks to go and fund themselves. If they wanted money, they had to go back to their shareholders. If they wanted extra funds to do additional investments, they had to go to their shareholders. So there were more stringent rules limiting banks on taking riskier assets, which the industry identified itself as being very, very costly. So the Act came in and it settled things down. Now, the problem is that on this 3rd of February, Donald Trump signed an executive order requiring the US Treasury to submit possible regulatory changes, and that he wanted to see them in the next 4 months. So Republican lawmakers argued that the Dodd-Frank Act is burdensome for financial institutions. Now, arguably, the current US model remains even less stringent than the Australian model as it currently stands. So keeping that in mind, our banks, of course, did not fail during the GFC. Our system held up, and our government did not have to bail out any bank. So reducing the regulation seems to be allowing some of the big banks to return to the bad old days. Now, this is a worry. It is likely that if the Dodd-Frank Act is made impotent, shares in Australian banks may well rally. Investors need to be wary of these types of scenarios. During the GFC, Australian banks remained strong because of our stringent regulations compared to the US. So at Southerton's, we welcome the improved financial legislation climate that currently exists and has rid the market of many cowboys that had been in the industry. So call us at Southerton's for your financial planning needs or any financial question you may have on 4972 1300. Thanks for watching.